When you look at returns over the last 15 years, we're running returns 50% above the average return of the market since 1900. So over 125 years in the last 15, we've run average returns, 50% above norms. You can't sustain that forever, particularly when the economy is growing at 2%. So that increases this risk of potential downside, and reversions to the mean is the most powerful force in investing. Again, when you look at any asset class, stocks, bonds, crypto, precious metals, whatever, watch the mean, because that mean average is where price is going to revert to at some point. It's just a function of time. Something will cause it, and you're going to have this reversion to the mean. And when you're trading at 2 standard deviations or 3 or 4 from long-term means, that reversion becomes much more probable.
Welcome to Thoughtful Money. I'm Thoughtful Money founder and your host, Adam Taggart, welcoming you here at the first day of 2026, which also happens to be our first weekly market recap of the year. I'm joined as usual by the portfolio manager with that new car smell, Lance Roberts. Lance, how you doing?
I'm doing well. I'm doing really well. Maybe I think somebody left a fish in there, but other than that, yeah, it's all good.
Well, new year, new car smell. I see you've got the fireworks behind you there. I hope you and your wife especially, but you and your family had a great time ringing in the New Year's last night.
Well, actually, it was very low key last night. So we're just for everybody's awareness, we're actually recording this on Thursday. And so we'll have a full trading day on Friday, in the market. So whatever we talk about today may change tomorrow, but tomorrow's my wife's last chemo. So everybody's getting prepared for that tomorrow, and then we'll be done.
Great. And hey, very appropriate. You've got the fireworks there. That is a
Exactly.
phenomenal milestone to celebrate. Last time you gave us an update, you said that things were going about as well as one could hope. Is that hopefully still the case?
Oh yeah, yeah, absolutely. No, it's better than we could have hoped for. As we talked about last week, we ran this blood test that basically looks for evidence of disease in her system, and there was none. So she's termed what's NED, no evidence of disease. So it's a very good. It doesn't mean she doesn't have cancer. It doesn't mean she's cured by any stretch of the imagination, but it is a very positive, outcome for the test. And so we get through this last chemo, and then for the next 5 years, we'll be on 3-month visits, blood tests, checkups, those type of things. And then in 5 years, if she has no return of cancer, then she'll be considered to be in remission.
All right. Well, look, everyone watching's got their fingers crossed. They're continuing the prayers to come along. Hopefully, those 5 years go by swiftly and cancer-free, and we all get to celebrate in 5 years when you and I are probably still doing this.
I was gonna say let's not do the swiftly part because that'll put me at 65. But yeah, let's just get through the next 5 years.
All right, and I hope I know the chemo you don't feel
Yeah.
great after it, but hopefully after that that's behind her and she just starts feeling better and better and better.
Absolutely. Real quick before we get started in the show today, I just wanted to remind everybody to make sure, and if you haven't got your tickets yet for our 2026 Economic Summit, that's coming up just in about 2.5 weeks. It's on January the 17th. So again, Adam's going to be there the night before. We actually have a mixer where you can hang out with us and visit and talk. And we've got a really good lineup of speakers covering everything from cryptocurrency and stable coins to artificial intelligence. We've got a guy from BlackRock coming in to talk about that. Myself and Mike will be covering an outlook for stocks and for bonds for next year. And then also Ed Slott, who is America's financial planner, will be there talking about financial planning for 2026. So if you're nearing retirement, thinking about retiring, this is really the guy you want to hear to talk about what kind of steps you need to take for next year, particularly because of the enactment of the One Big Beautiful Bill. So go to our website, realinvestmentadvice.com, and there's a link right at the top of the page for the Economic Summit. You can register. It has all the details for you. But I would get your tickets if you're going to come. We'd love to have you. And we also have a block of rooms set aside at the hotel at a discounted rate. So, but those rooms are filling up pretty quickly. So if you are interested in coming, love to have you. It'll be a lot of fun. But be sure and get your tickets here pretty quick.
All right, and just to
There's
point
very
out for
limited
folks,
seating.
yeah, go to Real Investment Advice and then look up at the top of the page there. You've got that yellow register now button. That's what
Yeah,
you press. Yeah.
exactly. So
Okay.
yeah, anyway, so shameless plug, but thank you very much for that.
No, no, no. Glad you did. And that's coming up real fast. It just occurred to me that that is just a little more than 2 weeks away. So that'll be here before we know it. Always a great time. Looking forward to see you again in person, Lance.
Yeah,
Looking forward to seeing your wife too and giving her a big hug. And obviously looking forward to meeting a whole bunch of Thoughtful Money viewers who come. I always love getting to interact with you guys in the real world. It's really where I get my most valuable insights in terms of what I should focus on with this channel for the coming year. So folks, look forward to seeing you there.
absolutely.
All right, so we'll see how much we have to talk about. This might be a slightly smaller or shorter
Mhm.
uh, video than normal, though when I say that, they're usually longer. So we'll see if that streak continues into 2026. I do have a rant. I can imagine that you've got a lot to say about, Lance. So we'll get to that in a bit.
Sure.
But yeah, it has been, a little bit more of a quieter, week in the markets. Actually, 2 weeks because you were out last week,
Yeah.
and so we had Michael there, so I haven't seen you in 2 weeks. But the markets haven't done all that much, and we've had a number of holiday trading days there, days of non-trading. I guess my question for you, Lance, is, and maybe we just start by bringing up the S&P and looking at the TA. The market doesn't seem to have really gone anywhere since like late October. And looking at that now, I'm starting to smell a little bit of what we did back at the end of 2021 when the market, just couldn't seem to get to permanently higher highs. And then
Mhm.
everything kind of rolled over at the beginning of 2022. And,
Yeah.
who knows if the same thing's going to happen here, but we are entering the year like we did then with valuations at, pretty much record extremes. I think in some metrics, the only time they were exceeded was at the end of 2021.
Yeah.
So I'm just curious, are you hearing similar echoes as I hear?
Yeah. Yeah. And look, I mean, it's something you should definitely be concerned about. I mean, you've got bubbles in a variety of asset classes. And, I use that, that you got to be careful with that term. Bubbles immediately kind of elicit this whole environment that the world's going to crash. And, that's, things can remain elevated for a lot longer than people expect. And, that's kind of the old saying about logic and emotion. But look, you got, gold at record highs, silver at record highs, stocks near record highs. Bitcoin's about the only thing that kind of crashed this year. It was down about 10% for the year
Crashed.
total.
It was down what? A couple of single
10%.
digit percent for the
Yeah,
year?
no, it's down 10% for the year. But again, when everything is up, double digits or more, that's a terrible outcome, right? So, but like I said, every asset class did, even bonds did well this year. So, it's been one of those years where everybody's very complacent about risk. Everybody's got a narrative for why their particular asset class is doing well versus some other asset class. And it's kind of fascinating to me as everybody goes, "Oh, look, there's a bubble in stocks, but there's no bubble in precious metals." I mean, it's just, it's just, everybody's got a narrative for where bubbles exist, but what all that eventually matters is price deviations from long-term means. And the reason that is the most critical aspect going into next year is that markets solely function on one outcome, which is the demand of buyers versus the demand of sellers. And right now, you've got an imbalance of buyers versus sellers. In other words, you have more people wanting to buy the market than those wanting to sell. And that drags up the price because in order to get a seller to come to market, you've got to pay me enough to sell the asset that I have to you, right? So
Hmm.
you want to buy my Nvidia, you're going to have to pay me more for it tomorrow to buy it if you want me to sell it. Well, eventually you run out of sellers, or you run out of buyers, one of the two. And if you run out of buyers willing to pay a higher price, prices are going to mean revert fairly quickly. And again, we'll all point to some reason. Um, you know, this asset went down this year because of geopolitical risk, or this asset went down because of this reason over here. But whatever the reason is, it's just the event that caused the imbalance between buyers and sellers to reverse. And that's the big thing going into next year is to look at, where assets are trading in terms of their deviations from means and understand that when you have very large deviations, you have a bigger risk of reversion than not. And I think that's a huge risk for stocks next year.
Okay. Um, to that point, and again, maybe you can pull up the TA, Lance, so we can just sort of see the band that stocks have been trading in for the past
Mhm.
couple months. Um, uh, I think the answer is no, simply because I've been asking you and Michael every week recently. But given that risk, have you guys done any material de-risking yet in your portfolio? I'm guessing you haven't done too much until you start to see some technical breakdown, but
Right.
you tell me.
Yeah, no, that's absolutely right. I mean, the latest move that we made was in our all-weather portfolio, which is the portfolio that has all of our precious metals in it. We cut our exposure to silver back to its normal base level um, last week. Well, actually, I forget what week I'm in. The last, yeah, not this week, but last week. We reduced that back to target weight, took profits there because of that deviation from long-term
Mhm.
means. But other than that, no, everything else is fine. Markets are trading fine. Assets are trading well right now. There's not a lot of risk and perceived risk in the overall markets. So there's no reason to make big moves to de-risk. And this is one of the big mistakes that investors make over time is they identify some risk, right? They go, oh my gosh, the debt's going to cause the markets to crash by 50%. Okay, maybe, but it might be 5 years from now. And so they get out of the market and then they miss the market takes off running, keeps running, and then they're drugged back in towards the highs of the market. It's like, oh, I've got to get back in. I'm missing too much. And then that's about the time that whatever the event they were worried about actually happens. So,
Mhm.
the big thing that we have to identify as investors is understanding there's certainly some risk out there. In fact, I'm writing an article. This weekend's newsletter is going to kind of be covering, outlooks for next year. And I've been writing a lot about this over the last really 2 weeks. I just wrote an article Friday before last talking about the valuation ranges and what to expect in markets if markets have to revalue for either higher or lower valuations. That's a pretty big range, 8,100 on the upside to about 4,600 on the downside. So there's a pretty big range of potential outcomes in the markets for next year. Um, one of the other big risks next year is economic growth. Everybody's expecting really, really strong economic growth next year, but there's no guarantee that we're going to get really, really strong economic growth. Employment's certainly a concern. So there's a lot of variables that are going into the markets next year, but for right now, the market's looking past most of that and looking mostly at is the Fed going to cut rates and is economic growth going to be good next year? And so for right now, the markets are fairly convinced. You look at the average analyst estimate right now for the S&P next year, they're expecting between 12 and 17% returns next year for the market.
All right, 12 to 17% return. So that would get us to a four-peat
8,000.
year.
Yeah, you'd be
Pardon?
at 8,000 in
Yeah,
theory.
but that would be, we've been talking about how a three in a row string is
Mhm.
rare and a four in a row string is extremely rare. I would consider 12 to 17% in 2026 a four-peat year of, really good double-digit returns for the market. So the market is still feeling, uh, it's feeling frisky. Um, how are you feeling about the odds of a 12 to 70% year?
I don't really look at things that way.
Oh,
If we
but you
have
guys
12
have
to
to come up with your end
17%.
of year target at the beginning of the year.
Yeah, yeah. Well, no, I like I said, I just published the range of outcomes. I don't pick a target, I pick a range. And here, let me just show you
Oh,
this real quick.
well,
Yeah.
that's a pretty easy range to make.
Well, no, no.
You
And
said
the reason is
8,600
that
to 4,000.
no, this is where investors make all their mistakes, right? They go, oh, I want somebody to tell me that next year the market's going to hit 8,000 or it's going to hit 5,000, one of the two. And so they bank their whole outlook based on whatever quote unquote guru told them. Is like, oh, markets are going to, Ed Yardini, markets are going to 8,000 next year. Okay, maybe. What if they don't? Right? The whole point of managing assets is to manage risk. And you can't manage risk if you only have a one-sided outcome. You understand that?
Oh, I totally get it. And keep
Yeah.
going because you're going to talk about the important things that a good financial advisor does, which is say, here's the spectrum of probability. Here's how I'm positioning for each part of that spectrum,
Yeah.
right?
And so, right. And so if we have multiple expansion next year, which is what we've had for the last 3 years, then you can get an upside target of 8,100, but you're banking a lot on this multiple expansion idea. If we can just maintain the same multiples next year, the market should run to about 7,300. That's about a 4% advance from here. That's not great.
Hmm.
But if anything happens next year that causes, say, we have an economic slowdown, you could have a contraction. And again, this is all based on valuations. And what are valuations? Valuations are simply a function of what the market thinks companies are going to earn next year. It's about earnings, price divided by earnings. So if the economy slows down, earnings are going to slow down. We're not going to hit these, $330 a share in earnings. And so that will put you at about 6,200. If we have a correction back to 22 times earnings, we're currently at about 25 times earnings on the S&P on a reported basis. So we're only talking about a 3% collapse in valuations. That's not a lot, but that would pull the index down to about 6,200. If you have a recession, which is not entirely off the table, and we get valuations back to long-term means, which is around 17, 18, talking about 50, 80. So this is a really important, look at next year, because this range of probabilities is what we have to manage risk with. And again, when you look at returns over the last 15 years, we're running returns 50% above the average return of the market since 1900. So over 125 years, in the last 15, we've run average returns, 50% above norms. You can't sustain that forever, particularly when the economy is growing at 2%. So that increases this risk of potential downside. You've also got, kind of looking at 3-year returns, as you just said a second ago. Look at, we've had three of just huge return years in the markets. We're at 2 standard deviations above the 3-year moving average, and reversions to the mean is the most powerful force in investing. Again, when you look at any asset class, stocks, bonds, crypto, precious metals, whatever, watch the mean, because that mean average is where price is going to revert to at some point. It's just a function of time. Something will cause it, and you're going to have this reversion to the mean. And when you're trading at 2 standard deviations or 3 or 4 from long-term means, that reversion becomes much more probable. And so when you start looking at the fact that next year we've got this kind of mix of environment, you've got to start looking at your portfolio in terms of ranges. What's my upside potential? What's my downside potential? And how am I managing my risk looking into next year? So this is why we've lately been adding some defensive positioning to our portfolios. We still have our growth, right? We still own Google, we still own Nvidia, Microsoft, and Amazon, those guys, because the markets are doing okay. But we're also starting to add in this defensive positioning just in case something unexpected comes along, because the thing that causes the market to correct is not anything you're talking about with any of your guests right now. If there's somebody on your show talking about the housing market's going to cause the crash, or it's credit, or it's the government debt, or whatever, they're all wrong, because that's already priced in. If somebody knows about it and has talked about it, it's already priced into the markets. There's no original thought in the financial markets. What's going to cause the correction is something that is completely unexpected. Remember, last year in March, President Trump comes out and he holds up this sign at the Rose Garden with all these tariffs. Nobody was expecting that, and that's why the markets crashed 20%, because nobody knew that was coming. Everybody thought it was going to have 10% tariffs. We were all good with that. That was already priced in. Nobody was expecting 50% tariffs or 100% tariffs on China.
Yeah.
Right?
Let me interject on
So,
that, because we've talked about this a lot, and I totally agree. Though, even though we can't see the black swan that's coming,
mhm,
right? We by definition, it wouldn't be a black swan if we could see it coming.
right.
You can anticipate the buckets that it would be in, right?
No,
This is something that's going to
no.
change the market. Well, let me finish. This is
Okay,
something that's going to no, but you've got different risks out there.
sure.
Okay, multiple expansion, might not continue, or earnings might be lower than expected, right? So you could say, this black swan just happened, and that's likely to reprice earnings expectations, right? So you can today say, okay, here's my playbook if we get a surprise in each one of in these buckets, right? So you don't know what the black swan's going to be, but you know how you're going to react to it once you know what bucket it's in.
Well, yeah, yeah, but
Yeah.
but you can't define the bucket. That's my whole point. Think about it this way. I take a bunch of wood, right? I make a big pile of wood in my backyard, and then I pour gasoline all over it, and then nothing else happens. right? It'll sit there for years. The gasoline will eventually evaporate, the wood will rot, but nothing will ever happen until there's a catalyst, right? Somebody throws a match in it, gets struck by lightning, whatever it is, and all of a sudden I've got a huge fire. That's the whole point about the market. These things, you can look at all these risks, housing market, valuation risk, all these type of things. Nothing is going to change the market dynamics until a catalyst is induced. And the problem is we just don't know what that catalyst is going to be. And so you say, okay, well, if we can start looking at, say, okay, what are all these potential catalysts? And how would that affect different asset classes? But the problem is we don't know what it's going to be or when it's going to happen. And that's the big challenge for investing is that we can make the decision to go all into one particular. I think the dollar is going to crash next year and it's going to be the end of fiat currency. Great. So I'm going to go hide out all over in this other asset class expecting that to happen, but it doesn't happen. And everything else moves, the world moves past you. And so that's the risk you've got to navigate is understanding these risks are out there. But and we certainly have we have the wood, we've got the gasoline, we've got the tinder, we've got everything for a really good market correction at some point.
Yeah. You don't know
But
what the match is going to be, and you don't know
don't
even if
or
it's going to
when.
show
And
up.
and the big thing is it's I don't know what the match is going to be, and I don't know when. It could be
Right.
5 years from now.
That's what I was just saying. So
Yeah.
all I'm trying to say, which I
Yeah.
think you agree with, is it's not fatalistic, like, well, we don't know what's going to happen, so we're just going in as blind.
Yeah.
You can say, look, here are the different types of categories of repercussions that a black swan or a match could have. And I've got at least an advanced playbook so that if the world gets surprised by X, I can say, well, what's that likely to do? Okay, I've already got a playbook on the shelf for
Yeah.
that. And I've taken I've given some probability to that category
Mhm.
here at the beginning of the year. I maybe only give it 5% because I don't think it's very likely, but whoa, okay, I get surprised by it. I can dial that up as a much bigger percentage of my portfolio tomorrow because I've already put that playbook in place.
Right. And well, but that's also why, Adam, we talk a lot about taking profits, rebalancing back to targets, those type of things. That's the management part for navigating risk environment.
Yep.
And so again, this is why we're always like, what trades did you make last week? Well, we trimmed back this, we added to this, we did this, we did this. That's just that management process of risk over time because we don't know when or what is going to cause. We know, look, 100% guarantee. I'm going to agree with you, Adam. Here's the title for this week's video. Markets are going to crash by 50% or more. Right? There's
Right.
your title.
Right. You just don't know the when. Yep.
But it could be 10 years from now. And,
Yep.
I want my job is to make money for my clients until that occurs. And then when that occurs, and this is the most important thing. I think this is the one thing that is the biggest impediment to investors being successful is that they go, oh, they hear some guy on the media say, oh, markets are going to crash by 50% next year. Okay, great. Well, the problem is market crashes. You're not going to wake up one morning and the market's going to be down 50% in a day, right? It's going to start deteriorating, and then that deterioration is going to start to accelerate, and then, the event, whatever it is, will actually show up. Markets will know what's coming before it happens. And so by the time the event shows up, the market will be down 5, 6, 7, 8, 9, 10%. Then the event will happen and we'll go down very quickly 50%. But that'll still be over a period of a couple of months. And the point about that is there's plenty of time after the market starts to deteriorate to begin reducing risk.
Hmm.
And so that's our whole methodology is to track the markets, to trend with the markets, to let the markets work for us, make us money while markets are going higher. But we're constantly aware of the risk. And when markets start to deteriorate, then we'll start aggressively reducing our allocation to equities. But there's no evidence of that right now.
Right, right. And so a couple of things off of that. One is, I mean, that's sort of why I asked you, hey, you've got some of these valuation concerns, but it doesn't seem like you are, de-risking materially because you're not seeing any sort of technical
Right.
breakdown in the markets yet, right? And maybe we don't get them in 2026. Who knows?
Yeah.
So you're eating or you're following your own rule set there. Let's put a pin in this part because it's going to be
Sure.
relevant to the rant. Um, the stuff you talk about all the time about position sizing and rebalancing and all that stuff, it is totally not sexy. I know you know that, right? It doesn't make for great headlines. People are probably tired of us, talking about it so often. But as you said, it's just sort of a best practice of of long-term wealth building. And we're going to get into this to the rant. A lot of times, it's the unsexy stuff that is the most effective in the long run.
Yeah.
And I'll leave that as a little teaser for why that's going to be relevant to the rant when we get to the rant. Let me ask you this though, Lance, with everything that you just said, agree with all of it. Um, when I look through some of the risks that you walk through in your charts there,
Yep.
earnings might be less than expected, or we might get a recession or whatever, right? Um, Personal opinion, you might not share it. I feel we can debate more what's going to happen with earnings next year. Like there are arguments to be made on both sides,
Mhm.
right? Like I know you think that small business earnings expectations seem pretty out of whack, or earnings growth for next year, right? It's like 50%
Yeah.
expected earning in the Russell. That I agree. That seems crazy. But who knows, right? So, we can definitely say that, hey, Wall Street's gotten, way ahead of its skis in terms of expectations. But then again, you can listen to arguments on the other side about all the tailwinds that are coming to the economy from everything that got put in place in 2025, right? And you might
Mhm.
agree, you might disagree. We can have healthy debate. The area where I have a harder time, and this is where I want to get your gut feel. So it's not a
Sure.
prediction, just a gut
Right.
feel, is
Gut
on
feel.
continued margin expansion.
Mhm.
Right. I mean, you showed the chart about how margins have just been going up year after year after year. We're now at total nosebleed levels that every time we've been anywhere near this in the past, there's been a market correction um, following. And again, this is not a great timing mechanism, but it's an indicator of risk. What does your gut tell you about margin expansion going over next year? Do you think there are decent odds for it to go even higher in CAPE ratios and stuff like that?
Okay, so two things. First of all, CAPE ratios are a function of pure valuation, right? Price and earnings. And
Hmm.
so I just the only reason I'm making this clarification is because I want to keep apples and apples together.
Sure, please.
So because you said profit margins, and that's a little bit different than earnings, right?
Oh,
I
okay. But yeah, my question was more on the multiple expansion. What
Yeah,
P we're giving on the PE ratio?
right.
Yeah.
But no, but profit margins are crucially important. And now it's
They
different than
are.
earnings. It's the margin that I'm making for every dollar I sell. So if I sell Adam, this bottle of water as an example, and I pay 80 cents for this bottle, I sell it to him for $1, my profit margin's 20%. Profit margins have been skyrocketing for the last 5 years
Yep.
because of the fact that most companies had refinanced debt previously at near zero interest rates, so they didn't have a lot of interest rate cost burden. The inflation that came through from the tariffs, not the sorry
Not the
the
tariffs. COVID.
stimulus checks to households, all the Inflation Reduction Act, all that money that went to the system that caused the inflation. That was great for businesses, right?
They passed
Because
most of it on. Yeah.
well, yeah, because I gave you money to spend. This is the big thing about government policy and why you should wholeheartedly reject anytime the government wants to step in and give you money. But if you give subsidies for childcare is going to go up in cost to cover that subsidy. And so it inflates everything. If you want cheaper healthcare, stop subsidizing healthcare because that just makes prices go up.
Mhm.
So, those type of actions were great for companies. Now, the risk, so now we've got profit margins at the highest level on record ever in history. And it's been great for companies. The big risk is they can't maintain that profit margin because as inflation comes down, as the economy slows down, demand is already declining. Take a look at what's happening with employment. And that's a reduction in demand. As demand falls, companies now have to start pricing things lower to sell product. They still need to make money. They still need to sell their product, good, or service, but they're going to have to charge less for it. And that's going to impact those profit margins.
Yeah.
Now,
And
earnings.
Jeremy Grantham, just real quick, was famous for
Yeah.
saying that profit margins were one of the most mean reverting data series in investing, but not
Absolutely.
recently.
But not look, everything mean reverts. Everything mean reverts in time. Now, just because things can remain elevated for 2 or 3 or 4 years or a longer period than we're normally used to, doesn't mean mean reversion is a thing of the past. It just means that mean reversion is going to be a lot bigger the next time it occurs. And so again, those are going to happen. And this happens and again, this applies to every asset class. There's no asset class that is immune from mean reversion. And that's just a function of timing. But now, to your point about earnings, earnings are a little bit different than profit margins because there's a lot of manipulation that goes into earnings,
Sure.
share buybacks, accounting gimmicks. Almost 20% of all earnings are a function of accounting gimmicks, right? I cookie jar reserves. I move forward revenue that I haven't even collected yet. And I book it as revenue this year. Those type of things occur, and that really that impacts that earnings per share number at the bottom. And again, that's why buybacks are so critical to companies to meet earnings, is because I buy back enough shares, I can make sure my earnings number per share beats the estimates. But we've seen a big expansion in valuations, and the big point about multiple expansion is that means the market is growing faster than earnings. And so the price of the market, we're paying more and more and more for the same dollar of earnings than we were willing to pay last year or for the year before. So if a company earns a dollar, 2 years ago, we would pay a dollar for that dollar. And today we're willing to pay $3 for that same dollar in earnings. And that's called multiple expansion. Now, that drives the market, but that's all enthusiasm, that's sentiment, that's psychology. And that's all a bet that the future is going to be extremely wonderful for companies. But there's a lot of potential risk over the next couple of years, slower economic growth, lower interest rates, lower inflation. Take a look at the EU is a good example of this. The US economy has grown by about 15 to 18% over the course of the last 5, 6 years. The European economy has barely grown at all. They don't have technological innovation. Next year, the IMF predicts that the Eurozone will grow at about 1%, and
Mm.
GDP in the US will be about 2%. So, when you start looking at these factors and looking at where asset prices are trading, that stuff just doesn't line up, and you're eventually going to get that reversion back to economic, because at the end of the day, where do earnings and profit margins come from? Comes from economic growth. If you and I aren't out spending money, these companies don't make anything. So it's hard to imagine how, with the economy slowing down, you can maintain valuations where they are. But again, that doesn't mean this year.
Okay. So thanks. A little bit of a long-winded answer to the question, which I'm going to re-ask again, which is let's just assume earnings flatline,
Okay.
right? So they don't even have to shrink. The market could still go up if
Mhm.
multiples continue to expand.
Correct.
That's the thing I have that not necessarily that the earnings are going to flatline, but that's the thing I have the harder time feeling confident in is that
Me too.
multiples are going to continue expanding next year because they are so stretched right now.
Right. And again, that is a risk, right? And that was the same risk we had this year.
Yeah,
Multiples.
I'm just asking you, how worried are you about that part, the
I was
multiple
worried
part?
about it this year. Remember, I wrote the article at the beginning of this year called Curb Your Enthusiasm.
Yeah.
Part of that analysis was based on valuation expansion and saying, look, it just doesn't seem reasonable that we can continue to expand multiples at the rate we're expanding multiples, but we did it, right? Um, so, again, that doesn't mean that in 2026 we're not going to do it again and push 40 times on a cape ratio or 42 times on a cape ratio. Maybe we'll hit the dot-com peak or exceed it. That's the thing about markets. They can certainly do that. I think it's a huge risk, but I think it's something you've got to give some at least some possibility to happening.
So is a Curb Your Enthusiasm 2.0 article in the works?
It's actually I'm using South Park this year.
Okay. But similar sentiment?
It's a similar kind of thesis, which is expect more volatility, potentially lower returns. I don't know how you're going to bank. So since 2019, we've turned in near 20% returns every single year except for 2022. Um, that's a very long stretch of very, very high returns. And again, doesn't mean a crash, but start thinking about a return to normal, which is 8 to 10% returns a year,
Right.
which will be
Right.
very disappointing for a lot of investors.
Yeah, wait, so this is sort of what I say, right? Like, your team wins the Super Bowl, you're excited, they win it again, right? A Super Bowl is about an analogy. Let's say NBA championships, because we've
Yeah,
had these dynasties. Um, you start taking it as a given. So then when your team only makes the playoffs, you're disappointed, right?
right.
In your two or three. Now we have a team that's pretty much made it to the NBA Finals, 3 years in a row, and right now the betting markets are suggesting that they're going to do it again. So a flat year will be totally disappointing. To your point, and I know you wouldn't be shocked at all. Again, not by a crash, but by a couple years of
Yeah.
negative single-digit growth, right? Which would be totally merited from a mean reversion standpoint, but would be totally disappointing to a market that has just become addicted essentially to double-digit returns now.
Yeah. Well, no, and then I just wrote an article last Friday talking about, kind of the economic factors behind valuations for next year. And, and I think the economy is probably one of the biggest risks because, for investors, the biggest risk is that earnings disappoint and earnings expectations, as we were talking about earlier, are very high. And what's really interesting is they're very high for the bottom 493 stocks. They're expecting 12% earnings growth next year, which they haven't done that in 5 years. So all of a sudden, we're going to get this massive expansion of earnings from the bottom 493 stocks, and the top 10 stocks that have driven virtually 100% of all the earnings growth over the last 5 years aren't
Hmm.
going to grow as fast. None of that makes any sense, but that's what the market believes right now.
Okay. Again, which is why you're cautious going into next year. You're not really changing anything yet because the markets are continuing to do what the markets have been doing, but
Yeah.
you're kind of on alert to
Oh, yeah.
things starting to wobble.
Yeah,
Okay.
no, you'll know. I mean, we'll start cutting exposure pretty aggressively. And look, we're probably going to cut a little bit of exposure next week, maybe,
Really?
and not by a lot. But we'll
No,
probably
but
go in
but
and
any
take some
is
profits.
notable.
And well, no, and the only reason is that we've had 8 straight months of positive returns. That's a very long stretch in the markets. Normally, markets can run 5 to 6 months on average, where you have consecutive every month. You're putting out a positive return. 8 months is getting really long in the tooth. So you're going to have a month or two of potentially, very, slightly negative returns, those type of things, a lot of slop potentially. So, again, we'll probably just go, we're overweight equities in our portfolio. So normally if in our kind of our flagship model, we run 60% equities and 40% fixed income. So right now we're about 65% equities. So we're overweight. So we'll probably pull that back to target weight, maybe slightly underneath. Maybe we'll go to 56, 57, 55, something like that. Just basically take profits and rebalance risk. Because I do think we're going to get a sloppy couple of months here, particularly, maybe the first of the year.
Let me ask you something a bit tangential here.
Mhm.
So this is a mid-year election,
Yep.
right? And the
Nervous.
the current administration's nervous that historically the incumbent party does poorly in the midterms because everybody's always frustrated that things aren't as great as they had been sold, right?
Right.
Um, what do you think would matter more to the outcome of the midterm election this year? Um, the stock market being sloppy, just
Yeah.
underwhelming, or the economy underwhelming. Let me put it this way. Let's say it's an underwhelming year in the markets, but the economy actually firms up. Would that have more or less impact, do you think, than the economy being sloppy, but the markets having a good year?
Well, look, historically speaking, the outcome of the economy in a election is what matters. People vote their pocketbook. And you and I both know that the vast majority of participation in the markets are in the top 20% of income earners. So the people that vote are going to be in that bottom 80%. They're more tied to what's happening economically. So if the economy is weak and their lifestyle is not improving, and I think this is a big risk in the midterms for the conservatives right now, the GOP, is that you take a look at sentiment indexes, et cetera, they're pretty poor. And that doesn't bode well for midterm elections. And so we could see very much a potential change in power, either in the House or the Senate. I'd probably not both, but it could be. But we could see at least a swap of power or control in either the House or the Senate, which would effectively put the government into gridlock, for the next 2 years after that.
Yeah, I mean, so personally, I think that's the outcome,
Mhm.
unless the administration makes people feel better about their pocketbooks. And my question to you, which is sort of leading, because I've shared the
Yeah.
same opinion as you, is, Trump has always touted the S&P as a scorecard, But I think what really matters more to people is really jobs. It's,
It does.
do I feel like I'm either going to keep my job and or get a raise and or I could get a better job than I have right now versus am I worried about my job? Am I losing out to inflation still with wages?
Yeah.
Or, if I want to skip to, a different employer, but no one's hiring, those are, I think that's really what's going to do it.
Yeah. And to be fair, though, every president in history has used the stock market as the benchmark of performance. So, every president points to the stock market. Oh, look at what the stock market did this year. I'm doing a great job.
Probably true, but not as much as Trump. I
No,
mean,
no,
Trump
it's
wears it on his
absolutely
sleeve.
true. Obama was a master at it. So,
Well, I don't know. We'll let people
but hey,
debate.
it's your political leanings, it's not mine. So I'm just saying facts are
Well, it's not
facts.
my political leanings. It's just
Yeah,
I
well,
just
no,
don't recall a president touting it, especially his first administration.
yeah,
And
no,
Trump, we've talked
it's
about this. Trump has started doing this. I think he's late to the game, as we talked about when he got elected. I thought first words out of his mouth when he got elected, before even getting sworn in, was, "Folks, it's going to be a rough year and a half while I dig out of this massive hole that my predecessor put me in," and just blame it all on the guy before. I feel like he really he didn't do as much of that nearly as I think he could have, and he's now trying to sort of scramble and say, well, hey folks, the good stuff's coming, but it's gonna still take a while. I don't think he's got a lot of time to make people feel better about their pocketbooks before people are going to cement who they're going to vote for.
oh no, I said that when he was first getting elected. I said if I was President Trump, I'd walk in and say, look, the next 3 years are going to absolutely suck. But we're gonna fix all these problems. We're gonna fix, the fraud. We're gonna fix the immigration issues. We're gonna fix the national security issues. We're gonna fix the foreign aid issues. But it's absolutely gonna suck in the economy as we do that. But if you'll stick with me, things will get a lot better on the other side. He should have hung to that message, and I think you could have navigated this market better. But again, there's a lot of stuff going on in the stock market that has nothing to do with policy at all. It's speculation, it's retail investing, it's a lot of other stuff that's driving the markets outside of. And again, at the end of the day, policy has very little effect on the markets. We tie those two together a lot, and we say, oh, look, the stock market's doing this, so that must mean the economy's booming. That's not necessarily the case,
Yeah.
but that's just how we tend to function those things. So
Yeah, not necessarily, but to your example earlier, tariff policy definitely kicked the market in the groin,
yeah, for about 20 minutes. And
But
then
well, tell that to the people who
and
lost,
every one of the people you interviewed, everybody that was out in the media, oh, tariffs are terrible. They're going to crash the economy. It's going to cause the economy going to massive recession. And we were over here saying that's not true. That's not going to happen. And it absolutely didn't happen. We've had no inflation pickup. We've had, the economy didn't crash into recession. Everything everybody said about tariffs was absolutely wrong.
well, I largely agree with that. Not everybody I interviewed, because I had these debates a lot. And tariffs, they did have some some goods price inflation impact, but it was a one-off. It's looking very
Mm.
much more now that it was a one-off price shock, like you and I had
Yeah.
predicted it would be. But no. I mean, look, we could talk all about tariffs, but I think Trump. I think, well, I don't want to say he's looking totally vindicated on it, but I think he is definitely, looking a lot more validated than he was 6 months ago. When you're right, I mean, every pundit
Yeah.
out there, certainly in the mainstream, was saying it was going to ruin the economy.
Yeah.
Okay, well, look, let's go through a little bit of a lightning round here, Lance.
Sure.
So, give me your 2026 outlook for on the following. Let's start
Okay.
with inflation.
Okay. 2%.
Okay, so a year
Say
of
lightning round.
disinflation.
So
We talked about this a lot 2 weeks ago, but it's going to be a year of disinflation, right? At least as measured by CPI.
well, yeah, I mean, I think inflation travels, if you take a look at 10-year, 5-year and 10-year expectations, forget CPI. If you want to do yourself a favor, forget CPI. I wouldn't even look at it. Just look at 5 and 10-year forward expectations on inflation. That never rose. Despite the fact we had 9% CPI following the pandemic stimulus, forward expectations never rose. And right now, forward expectations for inflation are about where CPI is trading, which forward expectations have been saying that for the last 5 years, is that inflation was going to come down to that level. So I think you're going to continue to moderate around 2.2% inflation. And that's about where your economic growth is going to be.
Okay, but that is disinflation, just to be clear from where we are right now, right?
Well,
Mild.
on an annualized basis, yes.
Yes, yes. Okay, good. All right.
And but that's what, hold on, let's clarify something real fast. Disinflation is falling prices. We are not going to have falling prices.
No, 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 no.
Going to,
Disinflation is a falling rate of inflation.
I know, but for people, right, when you say disinflation, people think, oh, prices are going to be lower. This has been the big argument, the big
Okay,
debate for
but
the
just to
last
be clear, this
few.
audience is smart enough, and I would say they know I meant deflation if I meant lower prices. So we're
Okay,
not
well,
saying
I
lower
just want
prices.
perfect. Okay, I just, we're not going to have lower prices. Prices are going to go up 2.2% next year. That's,
Yeah,
we're going to have inflation next year. That's a good thing because we want economic growth.
right.
But yes, we'll have a slower rate of inflation, to your point.
Yeah, and just to get super in the weeds on this, because inflation is a basket, we will, to get disinflation, we will have parts of the economy that will be deflating,
Mhm.
right?
Namely housing.
Exactly. Yeah, rents. Um, okay. So tied to that question, bonds and bond yields
Bond yields below four, um,
on the
probably
10-year.
somewhere in 3.5 to 3.75.
Okay.
Best guess. And that's
That's
it.
good.
That's assuming inflation returns back to 2%. Economic growth is around 2%. Slap on a small premium, you're at, 375-ish.
Right, right. So just to be super clear, that's a no recession
Yeah.
environment you're talking about
Yeah.
there.
Oh, you get in
Okay.
recession, yeah, you'll be 2% on rates.
Yep. Okay.
I
Uh,
don't want a recession, by the way.
you what?
I don't want a recession, by the way.
I know you don't want a recession, and to your point there, recession is not in your default forecast
Right.
for next year. Yeah.
Right.
Okay. Jobs.
Weaker. My big concern next year is that you get a stagnation in job growth. Every single jobs report this year has been revised lower. So I think the big risk, at least or in the early half of the year, is this kind of continuation of companies cutting back on employment to replace and basically using AI to replace employment, and we get a slower rate of employment growth. And I think that poses a risk economically, and that's also one of the catalysts behind lower rates of inflation. So I think that's one of the bigger risks to pay attention to, at least in the first half of this year.
Okay. And there's been so much debate over the quality of the jobs data that we've had.
Mhm.
I don't want to rehash all that. I just want to point out that if we look at things like the quits ratio,
Yeah,
that is like at recessionary levels right now.
yeah,
And that tends to be a pretty good indicator of the true sentiment of the worker, which is, hey, can I get rid of this job I have and go get a better one? And right now it is pretty resoundingly no.
yeah.
Um,
This is the thing that I'm paying most attention to. Full-time employment. Full-time employment is the key to the economy, right? If you've got three part-time jobs, great, wonderful, you're working your ass off, you're not going to really make any strong economic progress in your life, right? Just because part-time jobs don't provide benefits, they don't provide high enough wages to support a family of four, et cetera. So full-time employment is key in terms of economic output. Provides benefits, provides higher incomes, those type of things. That rate of full-time employment relative to the working age population is falling pretty quickly. That only happens during recessionary environments.
yeah, and we're still seeing that fall right now, right? Where
Yeah.
we're so
Well,
so
this
the
data is as of last Friday.
okay, so the impact of deportations, meaning 2.5 million bodies
Mhm.
that have presumably been removed from the population, that doesn't seem to be slowing this at all yet in terms of, freeing up other jobs that people, might be able to
Well, and
take.
again, I don't know what the mix was of the people that we were, the people have been deported. Were those full-time workers at high wage paying jobs? Were they working in the oil and gas field, or were they doctors or lawyers? I probably would suspect no. So, the impact to full-time employment and relative to the working age population is probably not changing that dynamic much.
Yeah, well, clearly not in the data you have here.
No.
I think there's been discussion of, hey, you get a bunch of guys who were working construction sites or in the oil gas field or whatever who aren't there anymore, then maybe demand increases, maybe even wages increases for the remaining, you know, U.S. citizens who are here who could be taking those
Yeah,
jobs. But again, that's why I was asking. It doesn't seem to be having any impact as you can see in the data yet.
not yet, but here's the key though. This is the black line is that same chart. This is full-time employment as a percentage of the population. What you'll notice is there's a fairly decent correlation between the ebbs and flows of that versus inflation and personal consumption expenditures. So again, that this decline of full-time employment is a key driver why we're seeing a big drop in inflation as well as personal consumption expenditures.
Sure.
And if
Yeah.
that continues, then we're going to see a lot slower rate of economic growth this next year.
Right. Because fewer people employed full time, fewer people out there buying stuff.
Correct.
Yeah. Yeah. Okay. And this is one, again, just personal point of view. I've generally been pretty pessimistic about the employment market for the past couple of years, and I think that has proven out.
Mhm.
And there's a big part of me that still wants to be leaning into that going forward. Um, there is a part of me, though, as I've been bringing up recently, that is, at least hearing the administration, especially folks like Secretary of Treasury Scott Bessent, who is just saying, "Hey, don't undercount what's coming, folks." And we have seen certain segments of the economy that have started to see some pretty big job growth, especially around like data center construction and
Yeah.
stuff like that. And so this is just one of those areas where I'm now less confident in my leaning on it, because I feel it's sort of a wait and see game here.
Yeah.
And I would love for the administration to be correct here. I'd love to see, continued positive real wage growth and all that type of stuff. But I can easily see the train going off the rails here if this employment data starts getting worse.
No, so you make a good point. Look, the data center construction is going to be an economic boom, right? It is going, so if we spend, right now it's estimated we're going to spend about $4 trillion over the course of the next 5 to 7 years building these data centers and all the things that go along with it. So that runs a multiple of about 3x in the economy. So you're talking about a $12 trillion addition to economic growth over the next, 5 to 7 years.
I
So
mean, that's a tremendous amount of stimulus.
yeah. That's and that's great, right? That's jobs, that's employment, that's wages. And so yeah, we may see an economic tick up, right, for the next couple of years as all this activity kind of starts running kind of full steam. The problem though is that let's say it takes, I'm just throwing out numbers. Let's say I'm going to build one of these data centers like Amazon just built. It's the size of like 6 football fields,
Yeah.
and it takes 5,000 workers to build it. Once it's built, I need 500 workers to maintain it. Right. That's the backside of this is that, yeah, we may have this short-term boom in terms of economic growth and activity while we build all these things out. But then once they're built, that goes away.
Oh,
And
I'm there with you. This,
yeah,
I've ranted on this with sort of AI and robotics. I mean,
yeah,
I, 10 years from now, I'm very, very worried about job supply. But I could understand the argument for next couple of years.
yeah,
You build that those 5,000 workers build that factory. Well, they got to go and build the next one, right? And then there's other factories that need to be built at the same time and all that type of stuff, right? So,
yeah.
so
So
we'll see. Also,
I think there's an upside. I think you take a look at deregulation, the one big beautiful bill, tax
I was
cuts.
going to say taxes. I mean, they're saying that Americans are going to see the biggest tax rebate this year ever.
Yeah, well, and we'll see. I'm looking forward to it. I can certainly use one. Uh,
Yeah, but just
yeah,
assume that that's true for a moment.
that
That's going to really drive economic spending, right?
correct. And we could see a lot of stuff uptick near term that would help benefit the markets. And that's why I'm not super bearish about next year. I think that returns will be okay. Just from a statistical standpoint, I think maintaining another 20% year while possible is becoming more and more unlikely
Likely,
for a
yeah.
variety of reasons. But we could look, and that doesn't mean that just because we see an uptick in economic activity that the stock market goes to the moon.
Well,
Those don't
that's what I was
necessarily
just going to
correlate.
chime in on is these things technically are different, and you can
Yeah,
have a good year economically, but a bad year market wise, and a lot of
correct.
that has to do with valuations, right? And I know that they're a bad timing element, but a market can revert to the mean even
Absolutely.
though the economy is growing, right?
Yeah. And so yeah, there's a and again, here's the other problem, right? So and to that point specifically, let's just assume for a second next year we have 4% real after inflation economic growth. That's a boomer year, right? That's double
Yep.
what we're doing now. So great year. Inflation is going to go up. If you have 4% economic growth, you're going to have 3 to 4% inflation. Those cannot live in two different worlds. It's a function of they are one and part of the same. There's a very high correlation between economic growth and inflation over time. So if that happens, that's great, but the Fed can't cut rates anymore. The whole reason the market's been going up is because the Fed's been cutting rates. We want more monetary accommodation, so that's justifying high valuations having a lower discount rate. So to your point, and it's very valid, is that if we did have a boomer economy, it could be fantastic, terrible for the stock market because now we're having to tighten monetary policy. You have an inflation, pickup in inflation, a good pickup in inflation, by the way, because
Right.
now you
Provided
have higher
wages are growing.
wages. Yeah,
Yeah.
yeah, higher wages, more employment, more activity. It's fantastic. Companies are able to charge more. You can pay more. You don't care because you're making more money. That's all good, but that's not really great for the market.
Yeah. Okay. So bottom line here, again, my point of view, jobs is going to be even more important to watch this year
Yep,
to try to get a sense for which way it's going here. Yeah.
correct.
Okay. All right. Housing.
Big conundrum. I'm still working through that. It's interesting. If you take a look at housing activity, there's nothing going on. You take a look at the number, housing prices, when we talk about housing prices in general, we talk about the housing market, we're only talking about people on the fringe that are actively buying or selling a house. So if you're just sitting on your house, you're not affecting the market.
Right. And a much higher percentage than normal of them are affluent, which is what's keeping the average prices. Yeah.
Exactly. But there's no activity. There's no buyers buying a house. There's no seller selling a house. I live in a neighbor where my neighborhood is. So, a couple of years ago, Adam, I was renting a house and we were renovating an old house from the
Right.
1960s.
You moved into the ring, right? The really attractive part of
Yeah.
you. Yeah.
Yeah. So no, no, and I'm not in the ring. I'm outside.
Oh, are you? Okay. I just remember you
Yeah.
talking
I'm
about the
I'm
ring.
on, I'm in the energy corridor is
Okay.
where so we're just surrounded by energy companies. But anyway, it's a little pocket neighborhood. It's got a really good school district. It's a very quaint kind of housing, kind of a neighborhood where all the neighbors know each other and you're complete. It's kind of this little paradise outside of the whole hustle and bustle of the city. Um, and normally, when a house goes on the market in this neighborhood, it's very highly sought after. And so, if you can find a house in this neighborhood, it immediately sells. Generally, it'll be on the market for one day and it's sold. There's been three houses now for sale for 6 months that haven't sold, and they're having to cut prices.
Wow.
And that's
Hey,
the
folks,
first
if you want to
time
be a neighbor of Lance, this is your
it's
moment.
time to do it. But no, it's just very interesting, right? That we're starting to see more and more of that sitting around the market. So, I think next year we continue to see housing struggles. Affordability remains an issue, even if you bring rates down. The issue we've talked about before is that if I've got a mortgage at 3 or 4%, I'm not going to sell my house to go get a mortgage of 6 or 7%. It just doesn't make any sense.
Yeah.
So a lot of people are going to just sit on their houses next year. That's going to keep housing prices more stable than not, because again, you don't have any activity going on. And so housing prices don't crash as everybody's kind of expecting. And if rates go up, that's just going to make the housing market worse.
So, okay, I don't disagree with much of what you said there. I do think, though, that time is not the housing market's friend.
I
Um,
agree.
and we now we passed a few months ago the line where there's now more 6+% mortgages out there in
Mhm.
houses than there are, sub 4% ones or whatever
Right.
it was, right?
Yep.
So that lock-in effect is diminishing. At the same time, if the job market isn't improving, the weight of not just higher mortgage rates, but also just higher everything around home ownership
Mhm.
continues to weigh on people. And you just have the organic factor that builds over time of death and divorce and job loss and stuff like that. So
Yep.
there is some sort of breaking point in there. I don't know where it is. We've
Yeah.
certainly seen a number of markets where people have hit it, and really the trigger is inventory. That's really going to tell the tale. It's what has told the tale so far because we now really kind of have two housing markets. We've got some that are full blown in correction and some that are they're avoiding it. And the big differentiator between the two is how much inventory is on the market. So,
Well, and I think a lot of it too is just location, right? I mean, was having this conversation the other day with a young person, and when I say young person, somebody younger than 40.
right.
So, but I was having this conversation, and he was saying, he's like, "Oh, I can't afford a house," and I'm like, "Well, where are you looking?" He's like, "Los Angeles." I'm like, "Yeah, you can't afford a house in any of the major metros. You can't afford a house. You get outside of you go to Midwest, you can get houses pretty cheap." So, location is very, very important, and unfortunately, all of our housing indexes are based on 20 major markets. So
Right.
so prices are a little bit skewed by these housing market indexes because of where we measure them. If we actually had an average home price across the country, things probably would look a lot more affordable than they do right now. But again, nobody wants to live in Wyoming, right? There's a reason only 500,000 people live in Wyoming.
Well, it depends on where in Wyoming, but
Yeah, well, I'm just saying there's not a lot going on in
yeah,
Wyoming.
well, yeah, and it's cold enough where I live. It's wicked cold in Wyoming.
Yeah,
And
yeah.
a lot of
Personally, I would love to live in Wyoming, right?
yeah,
I just, I don't like people, so Wyoming would be perfect for
yeah,
me.
you'd switch from Landman to Yellowstone.
Correct.
Um, yeah, and of course the big determinant there though is no matter where you live, you got to have the income to
Yeah,
support the house that you're buying. So you got to find the right overlap of, where can I make enough
correct.
to afford the type of house that I want. Okay, so
But so the bottom line to your question is, I really don't have a clue what housing's going to do next year. It wouldn't surprise me if it's about the same as it is this year.
okay, but what I don't hear from you, I hear from you. What I hear saying is be the same or worse. I don't hear you saying, "Oh, I think there's good
No,
probability housing, enters a boom again."
yeah, no, I don't think there's anything. I don't think there's any supporting drivers right now to create a resurgence of massive buying activity.
Okay, I'm gonna ask you about your trades to get to the rant and wrap things up here. Unless there's anything else that's burning brightly on your radar, I haven't thought to
No.
ask you about yet.
No, only trade we did in the last really week and a half. And again, this was early last week. I said earlier in the show today is we just sold silver down to Target. It just has had a huge run. It's grossly deviated from its long-term mean, and now and we just wrote. I've got an article coming out next week on the risk in precious metals, which is the CME hiking margin rates. Which
Okay.
I wrote the article and then they hiked them again. So that's
Yeah.
that's one of the big risks coming up in the next couple of months.
Okay, so we talked about that at length last week with Michael, who I think scooped you by writing about that and
Yeah, he
publishing
did.
the article. So a couple things. So first, just kudos because who knows what's going to happen with silver from here. But if you sold a week ago, you trim back before silver had its 15% price correction. That being said, it's still trading at a very attractive high for the year. Not an all-time high for the year. That's what it hit a week ago in the futures market.
Right.
Um, and Michael did a good job last week, Lance, of explaining, both the chart history of silver when it has gone vertical, and it's only really gone vertical like this two other times before. Once it did, it gave up pretty much almost all its gains and was kind of dead money for a decade or more after.
There's there's a giant reason for that. Did he explain why?
Well, I mean, he certainly went through the margin hikes and how that was sort of the what do you want to call it? It wasn't
Yeah.
the first margin hike that did it. It took several, but once
Yeah.
it did, it really kind of broke the mania here. Now
But
there's,
there's a need, but
but
see, there's a need to keep silver around 30, say 25 to $30 because it's such a big economic input.
yes,
And this is always the one thing that people forget is they try to tie it off to other narratives. But when prices for an important commodity like silver get out of whack, it causes inflation in things like, electric vehicles, right? Because I've got to pass on that silver cost. So it's an inflationary impact. And when you have a very broad base of activity based on silver, which we do economically, it's not great for the economy. So you get a couple of things that go on. The reason, and it's always interesting to me because people immediately come out and go, "Oh, the CME is hiking margin rates too. They're manipulating the market." No, they're trying to keep prices in line with delivery, so you don't have failure to deliver. It keeps financial stability, which is hugely important. But it's also an economic issue. So there's going to be a push to push silver prices back down into us. And you take a long-term chart of silver and look back over time, it averages about 25 to 20 $25 on average in terms of silver, and that's a good economic level. It's like oil, right? We don't want oil at $150 a barrel. It's not good economically. We don't want it at 40 either, because that's not good economically. But there's a sweet spot where oil is really good for the economy to keep the economy growing. And it's the same thing for silver.
So in your write-up that hasn't been published yet,
Yeah.
if you can really provide detail around that, because the other side of that story that I've heard, Lance, which
Mhm.
is true, and actually silver is becoming increasingly essential, and you probably know the government just put it on a list of essential minerals.
That's right.
So it's becoming even more essential. And the demands for it are getting larger and larger, especially in an era of AI and renewable energy and all that stuff.
Mhm.
But the argument is sort of, yeah, silver is kind of a Giffen good, which is the more expensive it gets, the more folks go to buy it. And one of the reasons for it is because, yes, it's used in all sorts of electronics. It's the best conductor out there. It's the most conductive element. Um, but it's used in such small amounts that, like, in your iPhone, which has silver in it to work, it could quintuple and it wouldn't really impact the price of an iPhone because its component percentage is so
Mhm.
small. It's a percent of everything else.
Yep.
So if you've got data that sort of says, no, it's actually more, it's a bigger percentage of the overall price, I'd love to see that to then be able to
Yeah,
pull
no.
those
It's
discussions.
not it's not the function of an item, it's the cumulative effect across the economy. So again, you talk about EVs, you talk about iPhones, you talk about, all the different components that we have. And also don't forget, the one thing that people forget is that when prices rise to a certain level, it attracts supply. Every time copper runs up to a big moon, kind of does a moonshot, people go out and just start stripping down everything that's got copper in it and they go sell it, right? So you get
Yeah.
a reversion of supply. And so right now you've potentially got a shortage of this is kind of one of the arguments for it, is that you've got a shortage of silver. But when prices get to a high enough level, supply will come to the market. People will start selling off grandma's silverware, or that's what
Yep.
happened to the Hunt brothers back in the 90s, is people were scraping off the back of Polaroid film, to get the silver out of it.
Right. And there is truth in what you're saying. And that's, again, one of the things I've been warning people about is I think a component of what's been going on has been a shortage of physical metal in the system. And just kind of like during COVID, systems caught up by surprise. Our supply chains really, got wonky for a while. But then the system was able to react and free stuff up, and prices started coming down once they did that. There is probably going to be some component of that here. I totally agree with you. The one thing I just want to flag, because I know folks are going to flag it when you say, in the comments to what you said, silver is a little different than a lot of other minerals, especially like copper, right? There are other copper mines out there. There are copper mines that are just not economic at this stage, right? That at a certain level, they say, okay, we're going after that now. We can pull it
Right.
out and make a profit, right? Silver is largely a byproduct of other mining operations. There
Mhm.
aren't many silver mines out there. So it's not like oil, right? Where you can say, well, there's a whole bunch of wells that don't work at $50 a barrel, but they do work at $70 a barrel. We don't have that with silver mines. So you can't bring new production online easily. Now you can go raid grandma's tea kettle set and stuff like that. So there are
Well,
ways for that, but it's less easy to bring on new silver supply than it is a lot of other commodities.
right, but at the right price, I will drill an uneconomic mine, right?
Yeah, but that's my point is I don't know there are that many uneconomic silver mines just lying around to be tapped. There aren't that many pure silver
There's
mines out there.
probably a lot more than you think, particularly in Australia. So
Maybe, and look, I'll invite the audience here. If folks know, if they're
yeah.
more informed on this, please let me know because I'm not as
Well, no,
educated
no, but
as I
the
should
whole
be.
point though is that the cure for high prices is high
High
prices.
prices. Yeah, that's
And
true for everything to a certain
right,
extent.
right. So, again, you're going to attract supply to the market in some form or the other. And so one of the big risks, and again, so again, let's not get too far off topic, which is that, eventually, economically speaking, really high prices in silver is not good economically, because it is such a critical part of in terms of the mineral needs of the economy. So when it gets to a very high price, that's not economically viable. So again, there's going to be a push through a variety of measures, either increasing supply, hiking margin rates, whatever it is, to bring that price back down. And that's why, and that's why after these spikes, you come back down in price and you spend a decade going nowhere. So again, it's just really important is that if you're a big owner of silver, you should take advantage of this spike because it will go away at some point and things will return to a normal level where it's economically viable. And that's what, and again, maybe it's not 20 anymore, maybe it's 30, maybe it's 35. I don't know where that number is. It's just not 70.
Yeah, okay. So I'm going to leave it here because I know we've got people passionate on both sides here. The couple of
Yeah.
things I'll say is
Well, that's
one,
the whole point of the article,
no,
to be
and
honest.
I'm looking forward to reading it. And you know, there are other people out there who I think agree with you in the long run, that look, you know, this may be a surge and it may come back down to a lower baseline. Their question is, but how high is high? And you're seeing people out there who are making arguments for prices substantially higher from here. And who knows what's going to happen? All I'm saying is I probably wouldn't short here.
Oh no, absolutely not. And
And
we're
you
still
wouldn't
long,
either.
and look, we're still long our silver position. We just trimmed it back to targets, all we did.
Yeah, you're
We're
just
still
taking
we're
gains.
we're
Yeah.
we're currently long gold, palladium, platinum, and silver. So on copper. So it's we own all those metals, and we just trim them back to target. But no, we're not shorting anything. We're not predicting a crash. All we're saying is from a risk management standpoint and a profitability standpoint, if you're sitting on a bunch of silver, you should go cash some in. And this is also another thing is that people will figure this out as well. When prices start to drop, everybody that's sitting on silver will go sell it.
Right. And that,
And,
that tends to
and
be what waterfall these things down when they happen. Yeah.
right, and that's where that supply comes from. So, just don't forget to take profits. It doesn't mean sell everything. It doesn't mean the world's going to crash and end. Doesn't mean any of that. Could silver go to 100? Sure, it could certainly have to go to 200, maybe. Is gold going to go to 10,000? Possibly. But look, we've had predictions for years that oil was going to go to 300, 100, 190, 2000, whatever, and it doesn't happen because something breaks and brings those prices back down. And whenever we're speculating, we always speculate things just only go up forever. Reality is that doesn't happen.
Yeah. So the only other thing I'll say on this is just to show that I am listening to you, Lance, and that I'm following through on my cautions of people, which is just that vertical moves don't last long
Yeah.
in anything, in any asset. And so when silver was going just bananas, a week ago, and I was talking to Michael, um, I asked him the question about, well, what if you've got your physical ounces of silver that you believe the price is going to continue to go higher in the long run, and so you don't want to sell your ounces? What are some ways in which you can protect yourself? We talked about some hedging strategies.
Yeah.
I did, as I think I suggested I would, although, again, folks, none of this is personal financial advice. I did put a hedge on my silver position. I have already taken it off simply because the price, it was a short-term hedge and the price dropped 15% right away. So the hedge paid off very nicely.
Yeah.
Um, and I now get to think about, do I want to put a more midterm hedge back on here? But well, Lance and I don't even know if we really do, but we may differ on what silver's longer term potential is here. Um, I'm looking at the same extreme tape activity as him, and had been concerned enough to put on a hedge. So I'm eating that dog
And,
food.
and look, I don't really look at things in terms of long term. I just look at risk, right? So my whole job is just to manage risk. That's all I do. So, if Nvidia is a good example, let's just say Nvidia. Nvidia's been a great run. We've made a ton of money with Nvidia and companies like GE or Nova. I have no idea whether those stocks are going to continue to go higher, of next year, the next 10 years, or whatever they are. Maybe they do. We'll participate as long as that happens. But when things get out of whack, that's where we start moving things, doing some risk management to the portfolio, taking some profits, rebalancing, those type of things, because that allows us to survive the corrections when they occur. Yeah, we took profits in silver a week and a half ago. Now they're 15% cheaper. If they come down some more, we'll add silver. So what'll happen, and this is the way it works in the portfolio, let's just pick a number. Silver's 5% of the portfolio. Silver goes from 5 to 7% on the way up. So I take it from 7 back to 5. And then the price crashes, it goes from 5 to 3. I then buy it back up to 5. So we're always
Right.
working around that target allocation within the model. So we can buy cheaper, raise it up while it's cheaper, make money on it when it goes back up. When it goes from 5 back to 7, we trim it back to 5 again. That allows us to survive the long term, make money, and manage the volatility risk that goes along with it. What most people do is they buy stuff here, it goes to here, they never sell it, and then it crashes back to where it was or went lower, and then they sell at a loss. That's what happens to most people.
Yeah, that's actually a really good, just practical explanation of it all. And it's that, so we'll use this as the jumping part into the rant. It's that boring, unsexy stuff that actually is what works in the long run, might be the most meaningful thing in the long run, right? So, all right, so we're definitely not going to come in under time this one. So
Oh well,
I'm shooting for I'm
It's New
shooting for
Year's
an
Day.
average duration now. Yeah. Um, okay. So today's rant. Probably not a huge surprise to anyone who's been on the internet for the past couple of days, is about the fraud that appears to have been uncovered in Minnesota. It all was sort of sparked off by a citizen journalist, a kid, I mean, was it 23-year-old, 24-year-old,
Yeah,
named Nick
kid.
Shirley, who basically got a list of daycare centers in Minnesota that was compiled by a guy who's sort of been researching the suspected fraud for years, and said, "Look, I think that there's just an epidemic of these sort of fictitious daycare centers where they're collecting state and federal monies to operate, but they're not actually operating, right?" So this kid, Nick Shirley, uh, walked around with this guy with his list and just knocked on a whole bunch of doors of these daycare centers in Minnesota. And virtually everyone that he knocked on was either like completely deserted, or had somebody in there who didn't want to talk, uh, said, no, you can't enroll a kid in here. It just visually looked very validating of the fraud thesis. So it's set off this firestorm now where a lot of people are understandably outraged by that. It turns out it's not just daycares in Minnesota. It's also adult care centers, it's autism centers. So the suspected scope of this type of bilking of the state seems to be, potentially very widespread there. The current estimates, I don't really know where the estimates are coming from, so take them with a grain of salt, but that it's like 9 billion in fraud, which would be a pretty massive fraud, one of the largest, some are saying the largest ever. What's really interesting about this story is it's raising a ton of questions, right? One, hey, is this fraud actually real? Two, if it is real, how has it been able to persist for this long? A number of the companies that even were flagged in the Nick Shirley video, some of them have been flagged by sort of state investigators, Lance, like over a decade ago,
Yeah.
like back in 2013. So how could something that might have been operating since back then be allowed to persist at such a widespread amount, right? And it seems pretty hard to deny that if indeed it's real and it's as widespread as it is, that it's not just the fraudsters themselves, that there is sort of a symbiosis with state officials who are benefiting from this fraud, either from votes, either from getting kickbacks, either from getting, funding of their political campaigns. So it seems to be not just a story of criminal activity, but also corruption in politics. And then you add into that the media, where a lot of people who are saying, well, how has the media been so blind and asleep on this, where a 23-year-old kid with an iPhone can uncover all this in an afternoon, and the media, misses the ball, even though the story's kind of been in process for over a decade, right? And so there's a lot of people that are saying that there's media complicity here too. So it's kind of metastasized really quickly into this fireball of outrage. And it's not just related to Minnesota. We're seeing, a bunch of people pick up this ball and start doing Nick Shirley investigations in a whole bunch of other states that have been where there's been suspicion of this type of fraud as well. And there's already a bunch of videos you can find on YouTube of kind of similar results in Ohio and Illinois and California and Massachusetts and Maine. So, I mean, this may just be the tip of the iceberg here. It's really super interesting. Um, I kind of put on a post as I was watching all this in real time on X and said, you know, what's really frustrating to me here is if this fraud is real, like how long it takes for the wheels of justice to move here, right? Like, how can these, like, if you suspect a restaurant, if the health services suspects a restaurant of health violation, they shut it down immediately. And they say, look, you can't serve another, hamburger here until you prove to us that you've met our standards. So why has the state been continuing to allow these things to stay open and to give them state funds, even if there's a whiff of impropriety? Why don't you just shut them down and say, look, we'll turn you back on just as soon as you can prove that you're legit here, right? So I wrote that because I think that captured a lot of the frustration of a lot of people watching the videos. Now, what's been interesting is since I posted that, not because I posted it, but since I posted it, the government, the administration has actually, they initially cut off federal funding, federal funds to Minnesota daycares, but I think they've now done it nationally and have said basically, hey, look, this fraud now appears potentially so widespread that we got to put a big pause button on it. And we're not going to turn funds on until daycare providers can prove that they're actually legit here. Going to be really interesting to see what happens. There's been some pushback against that decision. Yes, I'm sure there are lots of legitimate daycares out there that are probably going to have a tricky time in the next couple of weeks. But if it's to staunch the type of fraud that might be going on here, if it's just 9 billion in Minnesota alone, Jesus, where might it be with the rest of the country, right? So I'll take a beat here, Lance. There's more that I want to talk about, and I do want to tie it to the boring, unsexy stuff. But I'm sure you've got some thoughts about this. Why don't you jump in?
Well, no, I mean, just this is why I'm against all government subsidies. I've always been against government subsidies. I don't think we should have child care tax credits. I don't think we should have any type of financial aid going out because again, it's just very easy because there's such a lack of oversight that it creates all kinds of economic problems. And everybody wants to worry about the $35 trillion in debt, but nobody wants to do anything about cleaning up the kind of the fraud that goes on in the system, whether it's Medicare, Social Security. There's fraud in all of that. And this is the problem with government accountability, and it's also a problem with subsidies. Look, childcare is a very lucrative business. There is no reason you need subsidies from the government, period. All right. You open up a daycare center that provides good quality childcare, you're going to be inundated with clients. That's just a function of reality in the society we live in today. So if you took away the child tax credits, government subsidies, cost of childcare would come down. Things would be more affordable because again, it's a function of supply and demand within the economy. But again, we keep affecting all of these market dynamics in the name of good. And again, there's plenty of arguments why people say, oh, well, we need this, poor people need this. It doesn't help them. All it does is increase the cost of goods and services to them by giving them those subsidies. It makes things worse over time. You may help them for a year, but after the year, inflation will eat up any ability that you gave them or any support that you gave them. And so that's why things never improve. But so, yeah, I mean, if you're going to fix the problem, either you need very strong, stringent guidelines on how these things are going to work. There needs to be look, in my business, we have all kinds of filings that we have to make every year with the SEC to make sure we're complying with all the rules. We have audits. We have all this crap that goes on that we've got to comply with. That should be the same thing for every government program that they want to put out there.
And as a guy who's regulated by the SEC, like I totally feel that, right? It was one of the things that was at the forefront of my mind. So yeah, I mean, so we've railed about this before, Lance, right? I mean, pretty much whenever the government gets involved in an industry, prices go up and it becomes way less efficient, right?
Take a look at healthcare.
Yeah, well, healthcare, education, we can just continue going down the list here. And it also opens the door to fraud, right? I really don't need to convince anybody in this, but we've all heard about the, gold-plated toilet seats and the $500 screwdriver and right, all that stuff. So I'm right there with you, which is like, hey, part of the solution is just to get the government out of so many of these things, right? And it does seem that the way that these get created is, well, no, Lance, people are having trouble making ends meet, so we need to subsidize their childcare. So we put this thing into place, and then all of a sudden, more and more funds get funded there, and then we start getting kickback, and it begins to become a feature of the system, right? And there's a lot of really corrosive aspects of that, which I'll get to in just a sec. I do want to say, though, that not only is this in other states, but it's other forms of fraud too, like other forms of entitlement spending. In California, they spend 25 billion a year on fighting homelessness, and yet the homelessness rate just continues to go up, right? They refer to it as the homeless industrial complex. And there's just a ton of industrial complexes like that now. The daycare industrial complex, the adult care industrial complex, like, there's just so many of these graphs going on right now. And why this is so important is, to your point, Lance, this is what Doge was really concocted to address, right? And I know a lot of people were disappointed with Doge's initial results, but I think one of the things that Doge, stepped into was the fact that this is the feature of the system, and there's so much resistance to trying to shed daylight in here that, go ahead.
I was just saying, no, I mean, don't you remember every time Doge came up with something, it's like, oh, there's this over here, the media would immediately rebut that, and then a judge would file an injunction stopping the stop. We like,
Right.
hey, we're going to cease payments to this, and some federal judge that was elected by the Biden administration or whatever would step in and go, no, that can't, you can't do that, you can't fire government employees, and so yeah, Doge was disappointing because they couldn't do anything. They didn't
Right.
let them do their
Because
job.
this is the system. These are the
Yeah,
antibodies of the
that's
system
that's the
trying
whole
to resist
point.
change. Yeah, exactly. So, so obviously this has been the past couple of days been very validating for Elon, right? And he put out, he's been covering this on his X account, but the thing that he put out that really caught me was two things. He said, hey, as bad as this looks in Minnesota and other states and the 25 billion for, homelessness in California, he said, you can wrap all that stuff together and it's a drop in the bucket compared to the fraud that's going on in the big three, in Social Security and Medicare and defense. So he's like, look, yeah, that's a problem, but it's a nothing burger compared to the real problem that's out there. And what the administration is now saying, which I find pretty easy to believe at this point, is the cost of all this fraud is the national deficit.
Yeah.
Meaning, if we could just not deceive ourselves, we could actually be running a balanced budget. We could be not adding to our debts, right?
Yeah.
We could be living within our means as a society. But it's because we've had, potentially so much crooked fraud and abuse now kind of baked into the system as this feature. That's why we're living with all the perils that a lot of people who watch this video lie awake at night concerned about: the debt, the deficit, the declining value of fiat currency, and all that stuff. In a large part, that's self-inflicted. And that, to me, Lance, is really like, that really hits home, because that's not necessary. Like, we could have a much better economy and a much better society, and probably be able to fund a lot of the things that we think should be funded that aren't today, if we just didn't steal from each other.
Yeah. Well, but again, it's just, when there is easy money with no oversight, people are going to steal it. I mean, that's just a fact of life. And this is just why, but again, we elect these people to go to Washington to serve our interests. They work for us, right? But when we send them to Washington, they just wind up working for themselves. And there's no oversight. There's no, and again, even when somebody gets caught, I mean, how, you take a look at Congress, like a big chunk of them have criminal records, right? They've been convicted of something.
Right. Or
Uh,
they're under massive suspicion that would put you in jail yesterday, right?
Absolutely, absolutely. But it's okay. That's a bug in the system, right? And but again, it's all about elections and campaigns and doing favors and scratching backs. And this is why I've said for years, you got to get rid of lobbies, you got to get rid of PACs, these NGOs got to go and get all that money out of the system. And until you do that, and that'd be a very simple process, right? Be like, look, PACs are now illegal, NGOs are now illegal. You cannot do this, right? You cannot raise money on behalf of political figures, period. End of story. These political figures are elected by the population. They work for us. They have a standard salary. That's it. So once you do that, all of a sudden you take all that fraud graft out of the system, and the system would start operating a lot more efficiently, and then put, controls over the money you're spending. Great. I'm going to give you $100 million to do whatever, but I want very strict accounting of where that money went. I want receipts. And as long as that's valid, it works. And there's no reason we can't do that. We have accounting systems. We've got
Exactly. We've got the freaking blockchain. I mean, we can track everything down to its most
exactly.
granular quantum now.
Right. There's no reason none of this can be done, but we just don't want to do it because there's too much money involved in it.
And that's the thing that's killing me here, right? Which is like the hearth that people gather around with thoughtful money is hey, we're worried about, all these unsustainable things that are going on. And I think the answer is they don't have to be unsustainable. Like if we literally just clean up our own home, a lot of these really big problems either go away or get much more manageable. We extend the duration out generations in the future. So look, I don't have all the answers here, but to your point, Lance, getting money out of politics, big part of it, super hard, right? But you you get what you demand, right? And I don't know how, I mean, look, this is feasible. I just don't know how realistic it is. We've talked about how like when there's a fire in an oil field, one of the ways in which they put out the fire, right, is dynamite, right? You explode the dynamite in the gusher of fire, and it consumes all the oxygen very quickly. And then all of a sudden you just have gushing oil now because the fire's been put out, right? And you can cap the well. I wonder if we could do something similar here where we literally just said, you know what? Every incumbent gone. We're electing a brand new set of Congress and everybody, and your mandate for your next term is rooting out fraud, is accountability. You don't need to pass a new bit of legislation about it, any new program or anything. Your job is just making sure that getting fraud is out. That's your mandate, right? Could we just
No.
and,
And here's why,
well,
right?
we could, but
No,
I
you
don't
can't.
think it's realistic. Yeah.
Well, you can't, because just as we saw with President Trump was elected on this mandate. His mandate was to go to Washington and clean up Washington. That was his whole thing. And that's why he got Elon Musk to come in with Doge. And what happened immediately? A firestorm. Elon Musk is going to steal Medicare and Medicaid from us. He's going to do this. It's going to be terrible. The media was all over this, just negative, negative, negative. And every time they came up with, hey, there's potential fraud here. Oh, that's not really fraud. There's this, there's that, there's this other thing. And then every federal judge in the country was going, oh, you can't do this, right? You can't stop funding of foreign aid. You can't stop, firing. You can't go fire government employees. What are you going to do in that environment? You could elect a whole new slate of people with the same idea and it'd be the same result, because the system is going to keep it from working. Right? You're going
Yeah.
to fire every
So
federal
you're right.
judge.
This is the quote unquote deep state. And I'm just wondering,
Yeah.
so, and again, I'm thinking idealistically here, so maybe, but I
Sure.
mean,
No,
so yeah.
I'm right. Trust me, I'm right with you.
So yeah, so Congress, but also the judicial system. Like, sorry, Judge, you guys, we're having snap elections. You can't run. You can run again, maybe in 2 years,
Yep.
right? But right now we're just cleaning house, and for 2 years, everybody has the mandate of just balance the books, right?
Right. And the media can no longer report on anything. The media's got to go.
No, I don't care. They're going to get replaced by other new forms of media. I worry
Right,
less about that one, but
but the new forms of media regurgitating the same form of old media, right? It's right versus left, and it's just this constant argument, right? So, this is the problem we have. We have a narrative problem, we've got a judicial problem, and we've got a administrative problem. And
there's actually one other problem that's really big. I just want to put on here. I don't know
sure.
if you've seen this video, but it was going pretty viral. It was a woman from Brazil who lives in America. She
Mhm.
might be a naturalized citizen now, but she's like, look, I'm from Brazil. And she's like, I'm starting to feel the outrage that the average American is feeling. The reason why we're so upset by these videos is because we've been doing what we've been told,
Mhm.
which is the fair thing to do. Work hard, do what follow the rules, stay on the right side of the law, right? And we're seeing these scofflaws over here who are totally bilking the system and making out like crazy. And I'm beginning to wonder, like, why didn't I just open a daycare yeah, fake daycare and just pocket all the money, right?
Thank you.
And she
Yes.
says, look, she's like, I'm from Brazil. I've seen what happens when the critical mass of the populace loses faith in the social contract and then starts to look at the system as something that is going to screw me by default. And therefore, I should screw the system
Right.
before the system screws me. And that's why you have in so many other countries this pervasive distrust of the government that people use to justify corruption, right?
That's
Because
right.
they say, well, it's a corrupt system, so whatever, right? And she's just like, you don't want to have that happen here because it is so incredibly hard to win back once it's become established in the
That's
national
right.
psyche, right?
Yeah.
It's a cultural thing. And she's right. Like, I don't know many countries that I can point to that say that they fell into that abyss and then they dug themselves out of it.
Right. No, that's absolutely true. And this is, look, this is your worry, right? I mean, you worry about the national debt, you worry about the deficits, you worry about inflation and, those type of things.
You
Most of
worry
those,
about your kids just
yeah,
doing everything right, but not being able to get ahead, right? Yeah.
yeah, exactly. And but this is all very solvable. It's just that nobody's willing to actually solve the problem. And when somebody does, like President Trump, then there's this huge pushback. Oh, we don't like Orange Man. So even though he's doing a good job, this is one of the funniest lines of his State of the Union address, which is, "I could cure cancer and y'all would still hate me," which is very true. And here he was trying to solve this very problem, and all he got was grief for it. And honestly, if I was him, I would have just said, "Fine, you know what? I'm not going to fix it. I'm just going to leave it the way it is. You live with it."
Yeah. So, and first off, I know folks are going to, sadly, this is a partisan issue. It
Yeah.
shouldn't be, but I've definitely seen people interpret, this recent data from very different ends of the political spectrum. I'll be the first to say, look, I don't think there's any angels here. I think there's fraud on both sides of the spectrum. It might not be equally distributed. I'll let people, argue that on their own. But this is not a single party. Fraud is not a single party issue going on here. Um,
You have to have, in order for fraud to work, you have to have two complicit parties.
exactly, exactly. And like I said, I think it has just become a feature of the system. Sadly, it's not a bug. But what I am becoming, I do maintain some optimism here, Lance. So
Mhm.
do I think we're going to get to my stage of just throw everybody out, replace them with people who have the mandate to clean things up? Sadly, I don't think that's going to happen anytime soon. But I do think that maybe Doja's legacy has been infecting the system with a desire for accountability that didn't exist before and a spark of hope that it is now becoming more possible than it was.
Mhm.
And I think what Nick Shirley did there was part of that contagion, right? Was somebody outside of the system saying, "Well, I'm just going to go see what I can do around this myself in this other part of the country here," right? And now we're seeing a lot of other, citizen journalists trying to do the same. But this is where I get to the unsexy part, right? Like when you think of the big rackets that existed before, Capone's, Chicago era and whatnot, a lot of the stuff it ended up being brought down by the bean counters, right? You probably remember the movie The Untouchables, right?
Yeah,
And
absolutely.
Kevin Costner built his team, and one of the guys was this nerdy little accountant, and Costner was basically just dismissing him for half the movie, until he realized he just couldn't get Capone these other ways. And the guy said, "Wait a minute, I think there's an Achilles heel here." And Costner was like, "Wait a minute, tell me more about that," right? And they use it to bring him down. They brought a lot of the mob gangsters down on RICO charges and stuff like that, right? A lot of times it's this super unsexy stuff that wins the day in the long run. And, we are having new technologies that make it easier to do the forensic accounting, that make it easier to find the lists of organizations that are getting funding from the state. So you can go and knock on the doors if you want to. Um, and I do maintain some hope here that when people vote in the future, yes, they're going to continue to pull that lever mainly on how they feel economically, but how they feel economically is going to start to be more tied to how much they trust the economic data, and that they are going to be hopefully demanding more from our elected officials, that fraud, waste, and abuse become something that has to be on their scorecard for a person to determine whether they're going to vote for that person or not. Maybe I'm being too idealistic. I don't know, but I am hopeful that we are starting to sense a little bit of a cultural change here, that you know what, anti-waste is something that's important to me when I cast a vote.
Yeah. Look, I think that would be great if people would actually start voting their conscience and start voting for a healthier, rather than just voting on, I don't like this person, so I'm not going to vote for him. Vote, is this person the best choice that I have for a better economic outcome? Because that's what affects me ultimately,
Right.
right?
But I just
Is
don't
this
think, I mean,
person,
correct me if I'm wrong, but
regardless,
I don't think 2 years ago, before 2 years ago, anybody really thought about waste, fraud, and abuse when they went into a voting booth.
no, look, I think people are fundamentally smart enough to understand that there's when you talk, look, we've been talking about $300 hammers at NASA for 30 years,
Right.
right? That's
But I guess the
nothing
point is,
new.
I don't think people felt like they had any control over it. I had no agency in that.
Yeah,
Now they might feel
yeah,
like it.
exactly. And so instead of voting your political leanings, we need to get rid of right and left. We need to get rid of all that nonsense. And we need to start just voting for this is the best person for the job, regardless of anything else. I don't like his personality. His personality doesn't matter. Is he good for the job? I don't like the way he looks. Who
Yeah.
cares?
So I'm
Is he
right there
good for
with
the
you.
job?
I'm just saying, I think the
Yeah.
definition of the job is now going to start including
Yes. And we need to
accountability
start
on,
electing,
yeah.
yes, we need to start electing individuals that are going, look, there's no reason Congress has one job, which is to basically control the purse strings of government. That's really their main job. And their whole job every year is to pass a budget and to make sure that we're in line with that budget in terms of spending, right? We haven't had a budget since Obama took office, right? We do these continuing resolutions that automatically increase spending by 8% every year. And in that environment, fraud and abuse are going to be common, right? If you just keep giving people more money every year and not making them accountable for their budget because you don't have a budget, why not just randomly send money everywhere it wants to go? Because
And isn't that like
nobody's
the most
accounting for it.
obvious truth ever? You make
Yes.
money plentiful and free with no strings attached, you're going to get fraud.
Yeah, exactly. And why wouldn't you? So again, we need to require, look, if we just required a budget, we could start solving some of these problems.
Well, over to my point, if we solve these problems, we would balance the budget.
Yeah. No,
Yeah,
no, they go hand in hand, but you got to have a
yeah,
budget to balance it, right? We don't even have a budget.
yeah, yeah. And the Pentagon, hasn't, but they've failed every audit for the past umpteen. I mean, it's just they're the lack of accountability, and I'll end here, has become the feature, and we need to make it more of the bug, and then figure out how to,
Don't
squash the
disagree.
bugs. All right. And with that, motherhood and apple pie and everything else. But I do take, I guess, long story short, I do take some optimism from the virality of what's going on right now, because I think the culturally, we may be hitting an important cultural turning
Yeah.
point where we just say, you know what, we actually care about this. You've woken the sleeping giant. We didn't think we had any agency. We're now realizing we're beginning to, and we're going to start holding your feet to the fire more on this type of stuff.
Yeah. And
Um,
look, this is where the administration needs to step in right now and says, look, we're going to suspend all payments to every state, not just they suspended payments to Minnesota. They need to
no,
suspend.
I think they've now done it to every state.
Okay,
I,
perfect.
I think that just happened. Yeah.
Yeah, so they need to do that to every state and then say, okay, we're suspending all payments until we have verification that these programs are real.
Well,
And
and we need to see, to the extent that uh, there are political parties that are tied and involved in this.
Mhm.
We need to see those people held accountable / like sent to jail. If you don't, if the people perpetrating this don't see that there's a price to be paid, it's just going to keep going on.
and understand this, when they suspend all these payments, federal judges, primarily from blue states, are going to file lawsuits against this. You need to understand that they are part of the problem.
Yeah, that's an interesting conversation, and we'll have to dig that for a later date. But if you feel, not making the argument, but I know people can and do, if you feel that our judiciary is captured in a similar way that a lot of people feel like the rest of our politicians are captured, what do you do about that?
They are
How do you
absolutely
clean that
they
house?
are
Because that's a
they are
harder house to clean.
absolutely captured.
Yeah. So it goes back to the old, who's watching the watchman?
Mhm.
How do you who replaces the watchman when it's their job to be the guards, right? It's interesting.
You gotta have the watchers that watch the watchers that watch the watchers.
I guess, yeah. So, anyways, different topic for different time. Well, Lance, Thanks. Another great week.
Yep.
Great start to the year. Wishing you and your family, particularly your wife, the happiest and best of New Year's ever. Hope everything goes well with her tomorrow. Please give her a huge, hug from the whole Thoughtful Money community on finishing the chemo. Great milestone. And we just, we only hope even better things lie ahead for all you.
Absolutely. And this is let me see if I can share this with you really quick because this actually kind of summed up my entire year. I showed my wife this yesterday. So yeah, Adam, I mean, look, I mean, 2025 was something, and I posted this video yesterday about hoping we wind up this year and get this behind us, but hopefully next year will be a much better year.
So, but put that video back up for a second. So I saw this clip, and so a couple of things about it. One, the company that made the robot was understandably really quick to post out there that this guy actually like hacked the software with some of his own programming. So they're like, hey, this wasn't our robot's fault based on our software. But what he did is he programmed it to mirror what he was doing. So you see he kicks, and then it kicks him in the groin, but then he hunches over, and the robot hunches over too.
So, yeah. But I thought this was ideal just for getting 2025 behind us and looking forward to a better next year.
Yeah. Oh, great. And it ties into the fraud, which is, look, that guy's pain was totally self-inflicted. All right. Well, look, thanks so much again, buddy. Everybody
Thanks.
else, wishing you the happiest of New Year's. And again, as always, thanks so much for watching.
In the next handful of months between now and the end of the year, silver is likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. To be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher price of gold. Well, right now, silver's 1.12%. Decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver's going. I think it could go into the hundreds. 100 to 200 would not surprise me.
Central bank and sovereign demand for silver is rising, supporting higher prices, while COMEX and LBMA delivery activity and ETF redemptions indicate big players are taking physical possession. Analysts view silver as undervalued versus gold and expect a breakout, targeting $60 to $70 by year-end, with potential $100 to $200 plus in a full monetary or credit stress scenario. Risks include unverified accumulation data and uncertain timing of delivery squeezes. Michael Oliver, CEO and founder of Momentum Structural Analysis, argues that measuring silver in dollar terms is almost meaningless. He sees silver potentially reaching $100 to $200 but takes it in stages, personally favoring silver miners over gold. Historically, silver has averaged around 2% of gold's price and even hit 3 to 3.5% in past bull markets, while today it sits at just 1.12%. With silver already up 42% this year versus gold's 37%, technical charts suggest an imminent breakout. Several well-known bullion commentators and dealers' voices like Andy, Bill Holter and Mike Maloney argue the market is now driven by huge physical demand, tightening supply and central bank sovereign buying, conditions that can push silver rapidly higher and make a $60 to $70 year-end print plausible. They point to record COMEX delivery interest, growing central bank interest in silver, and China's physical buying as the catalyst for an imminent breakout. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
I think it's really irrelevant. Yeah, as I said, so many years have passed that the real value of the money unit that we're measuring by, the dollar in this case, or you could do it with euros or anything else, is just meaningless. The decay in the dollar has been so great that, again, to match the real converted value of silver in 1980 at $50, you'd easily have to be a couple $100, maybe more. And in even 2011, you'd well over 100, I'm sure. So those are really sort of jokes. And our assessment is that, one, I don't know how high silver is going. I think it could go into the hundreds, 100 to 200, would not surprise me. But we're taking it in segments. And my own personal investments, which we show at the end of each report, the disclaimer, are heavily in silver miners as opposed to gold. Okay, though gold is the mama, it's going up. Silver has both outperformed and underperformed gold on a routine basis over the decades. And if you go back 50 years and look at what is the highest relationship of silver to gold in any one of those given years, and plot it. We have a graph we put in the latest report. 2%, meaning divide an ounce of silver into gold. Silver was 2% of the value of gold in 20 of those 50 years. So it's not absurdly, to be unexpected to see silver at 2% the price of gold. And in fact, in bull trends, like 1979, 1980, 2010 and 11, silver got up to 3.5 and higher the price of gold. Well, right now, silver's 1.12%. Okay. Still dirt cheap. It got under 1% recently, which is historically very, very low level. When you see that, buy it. But when that spread turns up, and it's been turning up sharply, well, just for example, this year, people don't realize this. Silver's up 42% on the year today. Gold's up 37%. And yet most people still think silver's lagging. It's not. It's catching up to gold. And there are certain technical levels not far above where we're trading right now that if silver spread versus gold can reach those levels, the spread chart and the momentum of the spread chart, which is what we look at, both technical metrics, have very clear pending triple top breakouts, meaning levels that they've stopped twice before. And if you punch up through that, these levels go back several years, by the way, you're breaking out big time. So if you looked at these charts, these spread relationship charts, and treated it as a price chart, you'd say, "Ooh boy, you break through that and I'm gonna blow the cork off this thing." The spread is about to do that, I think. And when it does, I think in the next handful of months between now and the end of the year, silver's likely to be in the $60 to $70 price range. And I think the surge will also carry us highly likely to a 2% level, which again is routine. Well, that's a huge move because we're talking almost doubling the current relative value of silver to gold very rapidly and going up to that, quote, normal 2% level. Because we're, like I said, 1.12% right now. So anyway, I think there's a huge explosive potential in silver, coincident with the rise in gold, but advancing more so. And so that's why my personal emphasis is in the silver aspect of the monetary metals.
Michael Oliver warns that relying too much on fundamentals can mislead investors about timing, like the analysts in The Big Short who were early but not immediately proven right. In 2025, silver has risen 45% so far, hitting about $42 by mid-September. Rising industrial demand for EVs and solar panels, continuous supply shortages of about 800 million ounces since 2021, and growing central bank and investor accumulation through physical holdings and ETFs are the main drivers of its climb. Although supply is static and demand is dominated by China, silver's industrial role is expanding. Nevertheless, until prices compel attention, markets frequently overlook such truths. More significantly, silver has historically been used in conjunction with gold as money. Confidence will crumble as inflation reduces purchasing power and people lose faith in institutions, currencies, and central banks. This transition from optimism to anxiety could be brought on by a declining stock market. Major systemic changes, like the Federal Reserve's demise or income tax reform, are made possible under that setting. That unrest will help silver as an industrial metal and as currency. Let's shift our attention towards the interview.
Well, first off, I don't look at it that much, and I try not to, okay, because I don't want to be distorted by a notion of fundamentals. Why? Because quite often fundamentals, even if they're true, even if your assumptions are correct, that doesn't tell you about the timing. Mm-hmm. You could be right and not be right in terms of price reaction for 2 years, okay? Do you remember the movie The Big Short?
Yeah.
The guy, these 3 or 4 analysts around the country, different guys, didn't know each other, all came up with the same conclusion. There's going to be a mortgage crisis. There's no way around it. They pounded the table. Okay. That was 2005, 2006. And it wasn't until late 2007 that the stock market finally topped. And it wasn't until 2008 finally that they said, I was right. So you get the point, fundamentals. Okay. Silver does have certain unique, we know the industrial aspect. It used to be, you take a picture, that silver was a key factor in photography. Now it's a key component of solar cells. And it's also, as I understand, essential in the big AI explosion because silver is such a good conductor. Okay, well, the numbers that I've seen, and I don't know the validity, they probably are because I see them from too many places, of supply demand on the industrial side is very tight. The annual production of silver is not increasing. It's plateaued and demand is continually increasing. And by the way, China is one of the chief demanders of silver because they're like 80-90% of global solar production, solar panels, which silver is essential. So anyway, that could become a factor where, let's say we cross 50 and CNBC needs an excuse to explain it. Okay. And that's a good excuse. Oh, well, the industrial demand. Well, that's true now, but sometimes it takes a while for that reality to finally be used as the excuse. The bigger issue is silver's money, just like gold. A lot of people like to treat it as not monetary metal, but as history shows it has been. In fact, the U.S. has had silver as official money, too. So I think the crisis we're facing in global assets, global suffering, economic suffering, not just U.S., is going to be such that you're going to get a lot of things thrown up in the air in doubt, where you doubt the validity of a certain institution to provide what it's supposed to provide, like the central bank. You suddenly realize the value of the stuff in your wallet is decaying so rapidly it's ridiculous. As I said, your grandfather, father, and you, house cost, loaf of bread price when I was a kid, it's 52 card pickup. And I think the stock market will be a big key in that. Why? Because right now, if you look at, let's say, the average guy who's got a retirement account, maybe it's through state government pension fund or whatever, if he looks at it nominally and it's been going up because if it reflects the S&P, then it's been going up. Okay. Not a lot, by the way, over the last year, but, single-digit percent still. It's the only thing he's got to smile at. Everything else in his life is questionable. Cost of things are going up, et cetera, et cetera. And when that goes down, then it's, oh, hell, what's good? All you need then is some layoffs, et cetera, et cetera. And suddenly the average guy, instead of a sense of expectation, is a sense of doubt. And that creates fear. And when you create fear, the tone of markets change. And that's when institutions can get overthrown, ousted, abolished. And so it wouldn't surprise me that in a year or two there's no Federal Reserve. If the economy gets bad enough, which I suspect it will, there may not be any income tax, simply because it doesn't function. They go to a sales tax, etc. All kinds of things can change in big ways. I think that's the kind of situation we're facing now.
As trust in fiat currencies and institutions declines, there is a chance for sharp movements. How much higher may silver's price realistically rise in the upcoming years if it even recovers to 2 to 3% of gold's value? Will a decline in trust in central banks hasten the adoption of silver as a monetary asset and an industrial necessity? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.
The point is we're seeing lots of silver that is being accumulated by the central banks. That's $2,225,790,000 worth of silver has come into COMEX. In the first week or so of the month, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 6 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. Most of the public has zero idea that there is a massive drive going on for gold and for silver. First week of September, you're seeing nearly $4 billion worth of metals stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend.
Central banks are quietly stockpiling huge amounts of silver, with Russia, China, Saudi Arabia, and India leading the charge. Saudi Arabia has made small but notable purchases of silver via ETFs recently, which may signal a shift in behavior. China has bought 21 metric tons of gold so far this year, 2025. It's part of their strategy to diversify away from the dollar and align reserve assets with their global status. The notion that BRICS and other developing nations are considering silver more seriously due to its dual uses is being more widely reported. India alone has accumulated 600 to 800 million ounces in the last 5 years, more than what COMEX and LBMA hold combined. The US, traditionally an importer of silver but never of gold, is now importing both, a clear sign of a much larger global trend toward physical accumulation of precious metals. Andy, the president and CEO of Miles Franklin Precious Metals, highlights that what makes today's market different is the sheer scale of physical gold and silver being accumulated, not just by investors but by central banks, with Russia allocating it in its 2025 to 2027 budget and Saudi Arabia making ETF purchases. COMEX deliveries of gold and silver remain historically high, signaling strong demand for physical metal, while a weaker US dollar is further boosting gold and drawing silver into reserve diversification strategies. Analysts like Mike Maloney see silver poised for significant upside in a potential monetary reset, though claims of India's massive silver accumulation and extreme delivery spikes remain unverified. Experts also warn that paper metals may not provide true protection in a crisis, driving the push toward physical holdings. Andy believes the public, meanwhile, remains largely unaware of this massive shift toward physical metals. As we dive into the video, don't forget to hit the bell icon and subscribe so you don't miss any updates.
Well, I think that what differentiates this market from anything I've ever seen, Ivan, and I've been doing this now for almost 36 years, is the amount of physical demand that is being accumulated. Now, we've talked at length about the central banks that have been buying gold. We're seeing action with the central banks buying silver. Now, of course, it started with Russia saying they were going to add it to their stockpile. First time I've ever seen a government do that. And then it mitigated moved towards China. Talking to guys like Sean Kuhn from Dolly Varden, he says, look, Andy, the Chinese, who are the second largest producer in the world, they told David Morgan they're the first, by the way, but needless to say, they're massive producers. Sean says they're flying all around Latin America, in particular places like Peru, even all the way up to Mexico, and pulling metal out of the ground before it's even called silver. They're buying doré, they're buying concentrate. They're paying double what the West will do to disintermediate the whole market, sending it back to China for refining. So you have the first or second largest producer in the world finds it significant enough to fly around the world and buy doré and concentrate right out of the ground from the miners, directly from the miners, and then sending it back to do so under the cover of anonymity, so to speak. No one really knows how much they're buying or what they're getting, but Sean can validate that is indeed what is happening. You look at the Central Bank of Saudi Arabia. Disappointing as it may be that they bought huge amounts of SLV, maybe one of the worst products I've ever seen ever in my career, because just as a side note, the short position right now in SLV is 53.97 million shares,
Wow.
which is it's grotesque, it's ridiculous. And remember what the prospectus said, BlackRock said, there could come a time when there's not enough silver to cover those short positions, buyer beware. But the point is, we're seeing lots of silver that is being accumulated by the central banks. What is really different to me, as far as I'm concerned, is the amount of silver that is coming into the COMEX. And, you know, last week I jotted down some numbers. In month to date in September, the number of contracts, and this was last week, I'm sure it's much more now, that stood for delivery was 10,599 contracts. Let's do the math real quick. 10,599 contracts times each contract weight being 5,000 ounces is 52,995,000 ounces. We'll multiply that, let's just call it by 42. That's $2,225,790,000 worth of silver has come into COMEX in the first week or so of the month. And this is what we've seen over and over and over again. The point I want to get across here is that when you have countries, Russia, China, Saudi Arabia, let's not forget about India, who's bought somewhere between 600 and 800 million ounces over the last 5 years. That's more than is on the COMEX and the LBMA combined. And now you see it happening in the United States. At this level, the people don't just have the most money that are standing for delivery. Now, when we say stand for delivery, mind you, this is going into COMEX. A lot of it leaves. A lot of it doesn't leave. So regardless if it's leaving COMEX or being put into an eligible account, not registered, meaning it's not available for sale, it's going into strong hands. To this degree, these people are not only the most well-funded traders on the planet, i.e. the central banks, the commercial banks, the very sophisticated traders that can stand for delivery on COMEX to the tune of billions of dollars every month since November, since the election, but they're also the most well-informed. And I think that's the most important thing to understand, is that the people at this level who swim in circles of 9-figure monthly acquisitions are not doing things just for kicks. They're doing it because they understand where we are going. They know the playbook. They are at the highest level of information. And that's what I take away from really where we're at this moment, is that price is relevant, but price is a tool of misdirection, allowing the big money to position before all of the people that you and I call friends outside of what we do for a living, talking about this stuff. The people who may be very smart, very bright, very well read, arguably just reading the wrong shit. And that's the problem. So most of the public has zero idea that there is a massive drive going on for gold and for silver in terms of delivery. Just as a side note, in the first 5 days or so, 6 days of the September contract, which is a non-delivery month, 3,626 gold contracts at 100 ounces apiece stood for delivery. So you're talking $1.5 billion there too.
Wow.
So in just the first week of September, you're seeing nearly $4 billion worth of metal stand for delivery. But this is what we've seen every single month. Now, we've always been an importer of silver, not always been, in fact, never, to my knowledge, been a net importer of gold. Both of them together signal a bigger move, a bigger trend, and that is that the smartest money in the world understands that there is a rush for physical acquisition of metal, bypassing the paper promises. So there you go. Crazy times, brother, and I think we're just beginning in silver.
Andy points out that central banks and BRICS sovereigns Russia, China, India, and Saudi Arabia are accelerating gold and silver accumulation, often buying ore and concentrates directly from miners, while the West relies more on paper vehicles like SLV. Russia confirmed BRICS talks on a new precious metals exchange with its own pricing, clearing, and auditing, reducing reliance on the Western system, while silver is gaining traction as a reserve asset, with reports of Russian buying and Saudi Arabia making first ETF-linked silver purchases. Analysts warn Western price suppression looks increasingly like misdirection, with BRICS building parallel commodity infrastructure to secure physical supply. Experts predict gold will remain strong, and silver could see outsized upside given its smaller market, though volatility and delivery bottlenecks may increase.
The only saving grace is, and maybe I would like to think they're not misinformed. See, if you and I bought SLV, we can never take possession. They can, because it's the amount that they purchased. You have to have a certain amount, and it's called a basket. If you are able to redeem a basket, which I don't know the exact amount, 20, 30, 40, $50 million worth, they can. So I'll give you an example. Kyle Bass, when he was running the fund for the Texas Teachers Union years ago, they bought, if I'm not mistaken, $1 billion worth of GLD. They stood for delivery. Saudi Arabia can do the same thing here. They do have the right to stand for delivery, and most of that metal, if I'm not mistaken, is held in the LBMA. So because they bought such a significant amount, they can stand for delivery. And maybe they had a reason behind doing that I'm not sure. For you and I, buying SLV is as dumb as a mud wall. Not only do you pay the capital gains for collectibles when you sell it, you can never take possession. It's custodied by JP Morgan and BlackRock. Of course, JP Morgan, as we have identified multiple times, paid the largest fine that the Justice Department had ever handed out at that point, $920 million or so, for manipulating the silver market. Well, and that was kind of, and the reason that I think that they got off so easily, I believe that this was done at the behest of the central bank, who gave them the green light to do this. And there are bigger reasons at play for holding down the monetary metals, but that's for another discussion. Simply to say, it was far more. In fact, you could argue that it was far more than just spooking. It was manipulation, and it was at one point thought it would be RICO charges, because in essence it's like the hitman kills someone, well, they can go after the mob boss because the mob boss ordered it. Well, the point of it is that who up the chain of JP Morgan understood this? Is it just the head trader, Michael Nowak, who was the sacrificial lamb that was put in jail for a couple of years? Or, I don't know. The point of it is that this is something that you can only manipulate a market, Ivan, for an extended period of time by pushing it in the direction that it is going. And I've been doing this for almost 36 years. Most of the time, the world didn't want gold and silver. They wanted U.S. bonds and U.S. stocks and real estate. They wanted what was, when things got scary, there was a rush to the dollar. What is happening now is that the big money around the world has become motivated, coordinated, and sophisticated, and they understand what's happening. The big money around the world largely being, when I say that, I'm talking the BRICS countries, in particular Russia, China, now Saudi Arabia, India. All of these countries understand, and they have been using the spoofing or the manipulation or the suppression of the metals market against us. In other words, hold the paper price down in the West, and then go all around the world and drain the supplies, especially off of exchanges around the globe that don't affect the price. The price is set in the West, so if you smash the price down on paper here and then buy it up there, and there, boy, that works out well. And they're smart enough to see the big picture. That's what they're doing. And then they go as far, and just ask yourself, the second largest producer of silver in the world, the largest producer of gold, don't sell an ounce. They fly all over the world and buy gold and silver in doré, which is a crudely refined bar, in concentrate, which is a byproduct of it, right from the miners, which completely disintermediates the amount and disintermediates the market and the commercial banks. They're thinking 2 or 3 steps ahead. They're playing 3D chess, we're playing checkers. So I think that this is something that is being used against us without saying so. They get it. I'll evidence it this way. I've spent a lot of time talking about the BRICS, and the BRICS grain exchange is something that is under development. And I listened to an interview about the guy who's running it a year ago, and he said, we here in the BRICS produce and consume in the global south more wheat than they do in the West. Yet we have no control over its price because that is controlled on COMEX. But with the development of the BRICS grain exchange, that will change. Now,
Wow.
They understand what we're doing with the precious metals, with the base metals. All of the things that we have suppressed for various reasons are now being used against us. It's jiu-jitsu. The premise being you use your opponent's leverage against them. And this is exactly what's happening right now, man.
Will central banks' increasing use of silver lead to a structural revaluation to that of gold? What potential effects may the establishment of a BRICS precious metals exchange have on shifting global pricing power and diminishing the importance of Western markets? If you enjoy the content, please like this video, subscribe to the channel, and press the bell icon for timely updates. We appreciate your support, and thank you for being with us.